please don't listen to this woman. This doesn't make any sense to me. Okay, she has a terrible track record.
Do you agree with everything Kevin O'Leary says?
Absolutely not, no. TikTok, the best place to learn economics. Or is it, hey, I'm Joeri, I have a PhD in economics, and I make economics science-based analysis here on Money and Macro. But today we're doing something a little different. Today my producer picked the wildest, most insightful or interesting TikToks and YouTube shorts she could find about economics and asked me to react to them. But just to be clear, I haven't seen any of these before, so what you're about to see are my honest first reactions and then potentially a second one if I have to do a little bit of fact checking to make sure that I give a proper response. So let's see what kind of economic wisdom or chaos the internet has in store for us today.
The stock market is projected to crash, followed by the economy. And you are not going to freak out, you're going to be ready. With the tariff wars, with the boycotts, if you needed another excuse to stop spending money, here's another one. I need all the girly pops that stop spending money at Target to have that money ready to invest once the market crashes. The 2008 stock market crash made so many people rich, and we're going to be one of them. If you have stocks, sell them now.
Okay, please don't listen to this woman. So in the beginning, she says the stock market is expected to crash. This is something that just doesn't work that way. In the sense that if everybody expects the stock market to crash, then it should have already crashed, because then of course people are not going to be holding their stocks. They should have already sold them. So I think for me, as an economist that has studied financial markets for a long time or studied research about financial markets, this is one of the key insights. Nobody knows what the stock market will do next. This is really one thing that researchers find all the time. The stock market is fundamentally unpredictable. So what she's essentially saying is buy the dip, meaning that, okay, if the stock market goes down now, in many cases in history, for example, the Great Recession, but also during COVID, you could have made a lot of money if you bought the dip. But the way I see it, there are two big problems with that. The first is you never know really what the dip is. And the second is that, yes, stock market always goes back up, has been the case for a very long time in the United States, in many other places, but not everywhere. It doesn't have to be that way. For example, the example that I always used in my classes when I taught financial economics is Japan. The bubble popped, the early 90s in Japan, a financial bubble. Stock market, the Nikkei index collapsed, and it really took more than 20 years for it to recover to the level that it was back then. So for most people then, buying the dip wouldn't have worked because you didn't know what the dip would have been. So you may have bought even still pretty high and you could have lost money.
Is the only reason that prices go up is due to inflation? Is that the only reason that prices will go up? Yes or no?
Inflation is defined as prices going up.
But I'm asking you, is that the only reason? I know what the inflation definition is.
Well,
is that the only reason?
It's not that it's due to inflation, it's that it is inflation.
Lord have mercy. I know, I get it. Is that the only reason that prices of gas and groceries will go up?
Wait.
Is because of inflation. Here, hold on.
A few moments later.
Wait. I want you to define the term inflation.
Dude, stop.
No.
12 seconds later.
Well, it's the general level of prices for goods and services rises, reducing the purchasing power of money over time.
Thank you. So you just defined inflation as rising prices.
Okay.
Bingo.
So I don't think you're getting this.
I don't think you're getting this. You just said, is the only reason for rising prices? Do you get that?
No, you're not. Hear me out. Hold on.
Walt, please just hear me out, please.
Yeah, so if you go on the internet, most people define inflation as all prices going up. So the guy here is correct. Prices going up cannot be the cause of prices going up. But the money supply expanding, which is the previous definition of inflation, could be, is not always, could be the cause of prices going up. So that's maybe something to keep in mind if you look at inflation videos, especially from the Bitcoin crowd. They tend to use a different definition of inflation than most economists and most people use today.
Listen, the last 70 years are not normal, Stephen. The last 70 years are not normal. The last 70 years in Europe and the US, where ordinary people like my dad could work for the post office on less than average wage and buy a house and support family, it's not normal. It's not normal in the world, and it's not normal in history. Most countries in the world are not like that. Most countries have a small super rich elite and a very large group of extremely poor people. That's most of the country, and it's most of history in this country, and it's most of history in the US. we talk about Charles Dickens. I read Hard Times. And this is written in the 19th century when Britain was like the industrial superpower of the whole world. And at the time, the government was talking about, should we tax these industrialists? And the industrialists were saying, if you tax us, we'll throw our factories into the sea. And it just reminds me,
Okay, I'm just going to stop it in the middle. I think he's right, in the sense that he's saying, look, the past 70 years or something is not a normal period economically speaking. And I think that's true. Actually, the period from the 1950s to the 1970s specifically is known as the golden age of capitalism in the West, at least. There was huge economic growth and then inequality actually went down. Now, that is something you just don't see that much. And I think gave a lot of hope to many people. And now that's just not there anymore. We've seen economic growth, but especially in the United States and the United Kingdom, where Gary's from, it's been very unequal, increasingly also in Europe. And yeah, it's true that this is going back to sort of a historical norm. In the Industrial Revolution in the United Kingdom, it was super unequal. The United States development in the early 20th century, late 19th century was super unequal. You had these oligarch classes. This, of course, is also the case in China today, it's the case in India today. In almost all emerging market economies, it's the case.
The only time we've ever really been able to provide decent living conditions for ordinary working people was the period after the war where we massively redistributed wealth. And now we're losing that holding of wealth of the middle class.
Can you acknowledge, though, that was a completely different time as it relates to being able to...
It was a different time, but, I could,
because of technology.
Nigeria today, Brazil today, the UK 300 years ago, France 200 years ago. There is only one specific time that we have ever successfully provided broad living standards for ordinary people, and it was a period of time where we protected a broadly equal wealth distribution and taxed the rich at very high rates.
Okay, technologically speaking, it's much easier today to move money across the world than it was in the golden age of capitalism. And that is true. Yes, you had super high taxes in the United States, the United Kingdom, for top earners in that time period, but that's not the only thing that defined or made the golden age of capitalism very different than most other times, because in this time you had huge or super stringent capital controls, meaning you could not move money across borders that easily. And today you can, and also in the time period that Gary mentions, with the rubber bands in the United States, with these oligarchs in the United Kingdom, money could move across borders super easily. This was a time of hyper globalization back then, and it is today again as well. And this is really the problem with the high taxes, with super high taxes. We're seeing it now in the United Kingdom, that a lot of millionaires or very rich people are leaving the United Kingdom. We have seen it, I think, in Norway as well, that they were increasing taxes there, and then just a lot of the people that were supposed to pay those taxes left to Switzerland in the case of Norway. And the problem is that you can easily do business across borders. So you can just keep your business in Norway and live in Switzerland and pay most of your taxes in Switzerland, which are much lower than in Norway. So I think what Gary says is mostly correct. But the host is also making a good point. There is a reason why we don't have those higher taxes at the moment today. You can say, look, that's morally unacceptable. Absolutely, that's a political point. But there is a reason it's more difficult to do that today, and that is the mobility of capital today is just so much higher that people can easily move somewhere or just have their money move somewhere else such that they pay lower taxes, and that's a problem. So my producers told me that in the UK there's this initiative that Gary supports, Tax the Super Rich, and it does take into account that people should continue to pay taxes even if they live elsewhere, but they earn their money in the United Kingdom. And that could be possible. Another major technological change today versus the golden age of capitalism is a massive loss of privacy, making us vulnerable to cybercrime. This is where today's video sponsor, Incogni, comes in. Today, you can often just Google someone to find out very personal information, such as, for example, a home address. This is very convenient for fraudsters who are increasingly using AI voice calls to scam people, using this very information that they've gathered about you to convince you of something or potentially your vulnerable relatives. Thankfully, there's a solution. Incogni, besides contacting data brokers to delete information about yourself or vulnerable friends and family members, they now have a new feature called Incogni's Custom Removals. Simply point them to where personal data about you or your loved ones is being exposed, and their privacy experts will handle the rest. While taking your personal data back may seem overwhelming, Incogni's custom removals feature makes it effortless. Just give Incogni the link to a website that is sharing your information and watch it disappear in no time. So, if you want to radically reduce the chance of either you or vulnerable loved ones becoming a victim of cybercrime, just visit incogni.com/moneymacro and use my personal discount code moneymacro for a 60% discount to remove your private data from the market. After which we can proceed to the next TikTok.
The truth is the Chinese economy is based on the US dollar in the sense that everything outside of their economy settles in USD. Nobody wants to take the Chinese yuan and hold that long term. They have no idea what the policymakers are going to do with it. So if you want to do business out of Hong Kong or out of China, you ask to settle in US dollars. And that's really what the Chinese are frustrated about.
So he says, look, the Chinese economy is based on the US dollar. Yeah, I think he's correct in the sense that the Chinese rely on the US global dollar system. And so for their exports, they're very often paid in dollars. And the Chinese renminbi is just not a world currency like the US dollar is. And this is a significant source of power for the US. Now, if they're actually frustrated about this, that's not so clear. They have made moves to internationalize their currency, and this would help them so much in their global power struggle against the US. But at the same time, O'Leary says, but you don't know what Chinese policymakers will do. I think that's partially true, although in many areas they're more stable than the US policymakers, which, you know, like, is Trump very predictable when it comes to dollar policy? Not so much, perhaps, although you do have an independent central bank in the US, which will help. But the main thing holding the Chinese currency back is that they have capital controls, meaning that you cannot, as a foreigner, easily get money out of China. And this, by, you know, of course, makes it a very unattractive currency for many foreigners to hold, but not everywhere. Like, for example, Russia has really switched to using the renminbi a lot internationally compared to the dollar because they are, of course, sanctioned. So this is changing a little bit, but I think the main point O'Leary is saying here is correct.
Do you agree with everything Kevin O'Leary says?
Absolutely not, no.
You blame the US's pressure for Japan's economic decline.
They were richer than any European country, than Germany, than France, than Italy. They've moved to the bottom of the rung now.
Yeah.
We effectively forced them to move faster, to open up and deregulate than culturally and politically they were ready to. There's this thing called the Plaza Accord in September 1985 where we pushed them to make their exchange rate more. And I used to say, well, you did that in 1985. We date the crisis in 1992. It's 7 years later. And I think I continued to think that. But I would say over the years, and particularly in recent years, I'm thinking, I was wrong. You know, these things unfold slowly. Crises don't happen overnight. They deregulated and it worked, but they didn't know what they were doing. And I think this was a huge mistake by Japan to agree. Financial repression's bad, but financial liberalization needs to be done gradually. And if you do it too quickly, you get a crisis. That's many crises caused by that.
Suppose that crisis hadn't happened. How much wealthier is Japan today?
Oh, I think 50% wealthier per person. I think way wealthier.
Okay, so this is very interesting. This was Kenneth Rogoff, very respected economist. I respect him a lot. I just disagree with him here in the sense that he just basically says, look, we as the United States ruined the Japanese economy through the Plaza Accord. This is a very common narrative, especially in China. The Chinese policymakers looked at this and said, we want to avoid this at all costs. What happened is that Japan had a huge trade surplus with the United States. The United States said, look, the dollar is overvalued. You, along with Germany, many European countries, France, I think as well, should lower your exchange rates artificially, or, you know, at least do that by government actions. And that happened. But there's a couple of points here that I can't square with his explanation, is that Germany and France also participated in this same agreement, and they didn't have this crisis then. Now, of course, he says, look, the Japanese then also were forced to liberalize their financial system too quickly. This caused a bubble. Yeah, I've read about that. I think could have played a role, absolutely. But at the same time, we've seen these kinds of bubbles in many places that didn't have something similar to this Plaza Accord as well. Circling back to China, China had their own huge real estate bubble. They also had this surplus. They never went into this Plaza Accord, and they went through the same thing as the Japanese. So I don't fully buy this, that everything that's good or bad that happens to other countries is because of something that the United States did.
Right now, the Bitcoin's around 105,000. Our forecast for 2030 is $1.5 million.
So you think Bitcoin will potentially multiply in value by 15 times in the next 5 years?
Mm-hmm.
Wow, that'd be pretty crazy.
The building blocks for that, the three biggest building blocks are institutional, which has barely started, store of value or digital gold. Young people are much more comfortable with digital gold than gold.
So on the institutional side, that means institutions, investment institutions start investing in it.
Mm-hmm.
Young people start investing in it as a way to save and store their money.
Yes, yes. And then the very important use case that many people do not discuss is how important Bitcoin and stablecoins, which are backed by US Treasuries, are going to become to the emerging markets. In emerging markets, many of them are at the whim of policymakers who show no discipline in fiscal or monetary policy. And so they're used to going through booms and busts and booms and bailed out by the IMF, and they need an insurance policy.
So if you're in Venezuela, you need a currency that's going to be stable.
Exactly.
Okay. Cathie Wood, very famous investor. First note is, at least in the last few years, she has a terrible track record. So she is very famous, I think, mostly for predicting technology stocks would always go up. And at first, of course, she made a lot of money with that, but then she also lost investors a lot of money, and she underperformed, I think, the stock market for a very long time. So look, the thing is, her job is to push certain assets. And if she is believable, then people invest in her fund. And so this is just, so she has a huge interest in saying this. That being said, you know, Bitcoin, what she says is, look, Bitcoin is increasingly digital gold and it's becoming important in emerging markets. That's something we've already seen. We have seen absolutely in emerging markets like Turkey, for example, that people are investing where the currency is very unstable, so you can lose the value of your money just declines over time. And what we've seen there is many people, not just young people, have been buying a lot of gold, have been buying also Bitcoin. Bitcoin is being used for this purpose, absolutely. But also other foreign currencies are very popular there, like euro, dollar. In Argentina, we've also seen the dollar being very important because it's relatively stable compared to the local currency. So Bitcoin is one of those assets. Will it go up by that much? Nobody knows. In financial markets, that's just something that keeps coming back again and again. Researchers have found that nobody knows this, but I just have to say that it's in her interest to say that. Like, she makes money if people believe her. So that was the last clip of this video. My overall takeaway from this is that I think YouTube Shorts and TikToks are very interesting, but it's absolutely clear that the barrier to entry to these platforms is very low indeed. But yeah, that was me trying out my new reaction format. My producer suggested it because it allowed me to talk about a lot of different subjects, such as inequality, that I don't always have time for in my regular analysis on this channel. Let me know in the comments if you want to see more of this, or that's also okay, rather not. I personally really liked recording this, and I actually recorded quite a few more responses that didn't make the cut for this video. These unedited reactions are available on Patreon and for YouTube members as a thank you for all of your continued support. Another way to support the channel though is by interacting with the sponsor if you like the product via my link. So if you want to protect your data, check out incogni.com/moneymacro for a 60% discount. It does really help out the channel because then they'll work with us again.